Ever wondered why selling a business asset like a piece of land your factory sits on, or maybe that heavy-duty machinery you've used for years, can lead to a completely different tax outcome than, say, just selling off some stock you own?
Right.
It's not just about the profit you pocket, it's really about how that profit gets legally categorized. And, well, that classification can dramatically shift your tax bill.
Absolutely.
Imagine you've been, diligently depreciating your machinery for years, expecting maybe a nice low tax capital gain when you finally sell it, but then boom, surprise.
Mm-hmm.
A rule like Section 1245 can just swoop in and turn that expected low tax gain into high tax ordinary income.
Yeah.
It could potentially wipe out, I don't know, a quarter, maybe even more of your after tax profit
Yeah.
almost overnight. That's the kind of aha moment we're digging for today.
That's a great example.
And understanding these nuanced rules isn't just for the tax accountants, right? It's
Well,
actually a critical, often overlooked tool for anyone looking to proactively optimize their financial position and, truly impact their bottom line.
that's exactly right. Today, our goal is really to cut through the jargon, kind of translate this intimidating tax language, and give you the clear, practical takeaways you need to make smarter financial moves.
Okay.
We're going to unpack the crucial distinctions between ordinary income and capital gains, dive into the powerful Section 1231 rules, which, as you hinted, can offer some pretty incredible benefits.
Mm-hmm.
And then we'll uncover the intricate mechanisms of depreciation recapture under Sections 1245 and 1250. Our mission is basically to transform these dense tax codes into clear, actionable insights for you,
Great.
revealing exactly how knowing these specifics can genuinely affect your financial health and, help you make more informed decisions about when and how to sell those important business assets.
Okay, so let's unpack this right from the very beginning. The fundamental first step when you're even thinking about selling any property, whether it's something personal, maybe in an investment or a piece of your business, is understanding if that asset is classified as capital or non-capital.
Right, the basic divide.
Yeah, it sounds like just more jargon, maybe another layer of tax complexity, but this distinction really sets the stage for everything that follows. It directly influences not only how much tax you'll ultimately pay, but also, crucially, how much of that hard-earned profit you actually get to keep.
That's the bottom line, isn't it?
Exactly. The difference between a capital gain and ordinary income, or, a capital loss and an ordinary loss, could mean a swing of thousands, maybe even tens of thousands, on your tax bill. So knowing this distinction is kind of your first line of defense, or offense, I guess, in tax planning.
Absolutely. So let's define what the IRS means by a capital asset. Generally, these are properties that you, the taxpayer, hold for investment purposes or for your personal use.
Okay, like what?
Well, think about tangible items like your family car that you drive every day, or maybe the furniture and fixtures inside your home. They're not used to generate business income.
Right.
Stocks and securities that you hold are also classic examples of capital assets, unless, of course, you're in the business of buying and selling them. Then you'd be considered a dealer, and that's a whole different kettle of fish.
Right.
This category also includes personal property that's simply not used in a trade or business, or real property that isn't connected to your business operations. Things like your interest in a partnership, the goodwill of a corporation when you sell a business, or even copyrights, literary, musical, or artistic compositions that you've purchased from someone else rather than having created them yourself. Those fall into this category.
Purchased, not created.
Exactly. And, of course, any other assets you hold purely for investment purposes, like maybe a rental property that isn't quite classified as a full-blown trade or business.
And why does this initial classification matter so much?
Well, the reason it matters so much and why this initial step is so vital is because capital assets generally receive capital treatment. For gains, particularly for you individual taxpayers, this can mean preferential tax rates.
Lower rates.
Yeah, potentially 0%, 15%, or 20% on long-term capital gains. Those are often significantly lower than your ordinary income tax rates, which can climb much higher.
Right.
So selling a stock at a gain after holding it for over a year could save you a significant amount in taxes compared to, say, earning that same amount as business income.
Makes sense.
But there's a flip side. Capital losses often have limitations on how much you can deduct each year. For individuals, you can generally only deduct up to $3,000 of net capital losses against your ordinary income in any given year.
Only 3,000.
Yeah, just $3,000 per year against ordinary income. So this contrast between the favorable gain rates and the limited loss deductions is a really key planning point that shapes a lot of financial decisions.
Okay, so that's capital assets.
Yeah.
Then we pivot to what are called non-capital assets.
Right, the other side of the coin.
These are properties that generally receive ordinary treatment, meaning any gain or loss you recognize from their sale is typically taxed at your ordinary income rates.
Mm.
And as we just discussed, those rates can be considerably higher for gains. But as with most things in the labyrinthine world of tax,
Yes.
there are some very important and interesting exceptions that we're about to dive into. Exceptions that can drastically change the outcome.
Definitely.
So what falls into this non-capital bucket? The classic example is inventory that's property you normally hold specifically for sale to your customers in the ordinary course of your business.
Right, stock and trade.
Think about a retail store's merchandise, or maybe a home builder's houses for sale. If they sell these, it's ordinary income.
Makes sense.
Another common one is accounts and notes receivable that arise directly from sales or services you've provided in your business. When you collect on those, it's ordinary business income.
Straightforward.
It also covers copyrights, literary, musical, or artistic compositions if they are held by the original artist themselves.
The creator.
Right. So if you're a songwriter and you sell the rights to a song you wrote, that's typically ordinary income. Though, and this is a fascinating little carve-out, Congress actually introduced an exception for sales of musical compositions held by the original artist. Those can get capital gains treatment. It's a specific incentive designed to encourage artistic creation in that field.
Interesting. A specific exception just for music.
Yeah. And then you have unique cases like treasury stock, which isn't really considered an ordinary asset, nor does it get capital gains treatment. It's a very specific corporate accounting thing.
Right, separate category.
But here's where it gets really interesting and where the strategic thinking for business owners comes into sharp focus. We're talking about depreciable personal property and real estate that are used in your trade or business.
Okay, the business workhorses.
Exactly. These assets, things like your delivery trucks, your computers, your manufacturing equipment, or the office building where your business operates, are often referred to by their specific tax code sections, mainly Section 1231, Section 1245, and Section 1250 property.
The famous sections.
What makes them so compelling is that, unlike the sort of clear-cut capital or non-capital classifications we just discussed, these assets can actually be either capital or ordinary, depending on a pretty complex set of rules.
The hybrid category.
Right. This is where a simple asset disposal can transform into a sophisticated tax planning opportunity, potentially allowing for more favorable tax treatment than you might initially expect. It's definitely not a straightforward all capital or all ordinary answer.
No, far from it.
This is precisely where understanding these intricate rules truly empowers you to make better, more financially advantageous decisions.
Indeed, and that perfectly segues us into Section 1231 property, which, as you hinted, is often considered the best of both worlds in the tax code.
Usually.
Usually, yes. Most of the time. What's truly fascinating here, and quite a powerful benefit for business owners, is how Section 1231 attempts to give you an incredible advantage. It offers capital gain treatment on net gains and ordinary loss treatment on net losses.
Best of both, yeah.
Think about it. If you sell a business asset at a gain, you might get those preferential capital gain rates. But if you sell another at a loss, you might get the fully deductible ordinary loss treatment.
So win-win.
It seems like a win-win scenario, providing the most advantageous outcome for both possibilities. Now, to be precise, Section 1231 assets are defined quite simply. They are assets used in a taxpayer's trade or business, and critically, they must have been held for more than 12 months.
The holding period is key.
Paramount. This long-term holding period is essential for qualifying. This rule exists largely to encourage businesses to invest in and dispose of their assets in a way that fuels economic activity, providing a tax cushion for losses and a tax incentive for gains.
That really paints a picture of why 1231 is so powerful. But for our listener who's maybe thinking, okay, so how do I actually get that best of both worlds? Can you walk us through the netting process? How do these gains and losses actually combine, and what determines the final character?
Excellent question, because it's all about a netting process that takes place for any given tax year.
Yeah.
You basically gather up all your Section 1231 gains and all your Section 1231 losses for that year, and you combine them. You net them out.
Okay.
The overall result of that netting is what determines the ultimate tax character of your gain or loss.
So, two possible outcomes, though.
Essentially, yes.
Oh.
Let's look at the first, very favorable scenario. What happens if you have a net Section 1231 loss for the year?
Okay.
If, after combining all those gains and losses, the overall result is a net loss, then that entire amount is treated as an ordinary loss.
Ordinary loss, that sounds good.
And this, for you, the taxpayer, is an incredibly significant advantage. Unlike capital losses, which, as we mentioned, are severely limited in deduction.
Right, that $3,000 limit for individual.
Exactly. And C corporations can only offset capital losses against capital gains. But ordinary losses are generally not limited in deduction.
Not limited.
Not limited against other ordinary income. This means if you have a net Section 1231 loss, you can typically deduct that full amount against your other ordinary income, potentially reducing your taxable income dollar for dollar.
Wow.
This comes a huge win if you're, say, strategically selling off underperforming or older assets in your business. It provides an immediate and substantial tax benefit that can significantly offset other income you have. It's truly one of the most powerful provisions for business owners who face asset dispositions at a loss.
That's a massive benefit. Okay, so that's the loss scenario. What about the flip side? What if you have a net Section 1231 gain?
Right, the second scenario. If your combined 1231 gains and losses for the tax year actually result in a net Section 1231 gain, this is where the best of both worlds truly shines. Because that entire net gain is typically treated as a long-term capital gain.
Ah, the lower rates.
Exactly. For you, the individual taxpayer, this is particularly advantageous because net long-term capital gains are taxed at those incredibly attractive preferential rates, 0%, 15%, or 20%, depending on your overall income bracket. These rates are, in most cases, dramatically lower than your top ordinary income tax rates.
The difference.
Huge difference. For C corporations, while they don't get these same preferential rates, treating it as a capital gain is still valuable because it allows them to use that gain to offset any capital losses the corporation might have accumulated.
Okay, still useful.
Definitely. So, yes, it sounds almost too good to be true, doesn't it? Get ordinary loss treatment for losses and capital gain treatment for gains.
It does sound a bit too good. There's got to be a catch.
And you'd be right. As with many sweet deals in the tax code, there's a specific, often surprising twist that can sometimes turn what you thought was a capital gain into ordinary income. And that twist is the Section 1231 look-back rule.
Look-back rule. Okay, what's that about?
You've hit on the exact point, and that's precisely where the Section 1231 five-year look-back rule comes into play. This rule is essentially designed to ensure fairness and kind of prevent taxpayers from getting a double benefit.
Okay.
Here's the concept. If you happen to have a net Section 1231 gain this current year, before you could just enjoy those sweet capital gain rates, the IRS wants you to look back at the previous 5 tax years.
5 years.
5 years. They're checking. Did you deduct any net Section 1231 losses as ordinary losses during that specific 5-year period? If you did, you effectively received a very favorable tax break back then by deducting those losses without limitation.
Ah, okay, so they remember.
They remember. Now, the rule requires you to essentially pay back that ordinary benefit you received in those prior years.
Pay it back? How?
The mechanism is quite direct. Your current year's net, Section 1231 gain, is treated as ordinary income to the extent of those prior unrecaptured ordinary losses.
Oh, so it converts the gain.
Exactly. Think of it like paying back a loan. The IRS is basically saying, hey, we gave you a sweet deal with that ordinary loss deduction a few years back. Now that you're making a capital gain, we're going to take some of that benefit back first, turning it into ordinary income, before you get your preferential capital gain rates.
So my capital gain might not be all capital gain.
Precisely. What might have been a favorably taxed long-term capital gain could suddenly, and often surprisingly, become higher taxed ordinary income. Now, when you're applying this rule, you look back starting with the oldest year first.
Oldest year first.
Meaning if you had a loss in year 1 and then year 3 within the 5-year window, you'd recapture the year 1 loss first. And importantly, once a prior loss is paid back by converting an equivalent amount of current gain to ordinary income, that prior loss is essentially used up. It no longer triggers future recapture.
Okay, so it's a one-time payback for that specific loss.
Exactly. It's a one-time payment for that prior benefit. This is a critical rule to remember for anyone who's had, ups and downs in their business asset sales over the years.
Okay, let's make this concrete. Let's step into a real-world scenario with example 1 involving Lancaster Inc. Imagine Lancaster Inc., a manufacturing company. Like many businesses, it's had its share of ups and downs. Back in year 3, during a tough period, they sold some older equipment and took a significant $30,000 Section 1231 loss, which, because it was a net 1231 loss, was properly deducted as an ordinary loss, a great tax break at the time.
Right, they got the full deduction then.
Exactly. Now, we fast forward to year 7. The company's doing well. They've sold off a large piece of land they used for their factory, making a tidy $50,000 profit. On the surface, you'd think, fantastic, a pure $50,000 capital gain.
Feels like it.
But then the IRS's 5-year memory kicks in, because Lancaster Link had that $30,000 unrecaptured Section 1231 loss in year 3.
Within the 5-year window.
Right. Under the look-back rule, $30,000 of the current year's $50,000 gain must be treated as ordinary income. This effectively recaptures that prior benefit they received.
So $30K of the $50K gain becomes ordinary.
Yep. So of the total $50,000 gain, $30,000 is now taxed at higher ordinary income rates. Only the remaining $20,000 of the gain is then treated as a long-term capital gain, eligible for the lower capital gain rates.
Big difference in the tax bill there.
Huge. So what does this all mean for you, the business owner or investor listening? It means your tax planning isn't just about this year's transactions. If you've taken business losses in the past, and let's be honest, many businesses do, especially in early years or downturns,
Very common.
a seemingly great capital gain in the current year could surprisingly shift to ordinary income. This can dramatically impact your cash flow and your overall tax strategy. This is why a historical perspective, maybe reviewing past tax returns, is so vital when you're contemplating selling a significant business asset.
Absolutely. Proactive review is key.
It's a step that can save you from a very unwelcome tax surprise later.
That's a perfect lead into our next major area, depreciation recapture. Now here's where the tax implications get even more intricate, and where understanding the specifics can truly prevent a major tax surprise.
Okay, depreciation recapture. Sounds ominous.
Huh? Well, it can be if you're not prepared. When you sell depreciated assets, those pieces of equipment, vehicles, or buildings that you've been diligently deducting depreciation on over the years, lowering your taxable income.
Right, getting those deductions each year.
The government generally wants to recapture some of those tax benefits you received. It's essentially the IRS saying, look, you took a deduction back then, reducing your income. Now that you're selling the asset for a profit, effectively proving that its value wasn't lost as quickly as the depreciation suggested, we're going to get some of that tax benefit back by converting part of your gain from the potentially lower tax capital gain to higher taxed ordinary income.
So it's balancing the books on those deductions.
Exactly. It's a mechanism to balance the books on those past deductions.
It's almost like the tax code has its own personality, always full of surprises. So let's dive into the specifics, starting with Section 1245. What's that cover?
Let's do it. Section 1245 primarily deals with depreciable personal property.
Personal property, like equipment.
Exactly. Think of things like your business vehicles, office computers, heavy machinery, specialized equipment, or any other tangible property used in your trade or business that isn't real estate. Crucially, like Section 1231 property, these assets must have been used in a trade or business for more than 12 months.
Okay. Same holding period.
Same holding period. The recapture rule here is quite straightforward, but incredibly impactful. Upon the sale of a Section 1245 asset, the lesser of the recognized gain you made on the sale or the accumulated depreciation you've taken on that asset throughout its life, that amount is recaptured as ordinary income.
Lesser of gain or depreciation becomes ordinary income.
Got it. Right. This means that portion of your gain is taxed at your regular, higher income tax rates. Any remaining gain after this recapture, if there is any, meaning if the gain was bigger than the depreciation, is then treated as a Section 1231 gain.
Okay, so whatever's left over goes into the 1231 pot.
Exactly. This remaining amount then goes into that Section 1231 netting process we just discussed, potentially becoming long-term capital gain if you have a net 1231 gain for the year. But the key is that the depreciation you've benefited from gets clawed back first as ordinary income.
Okay, let's use example 2 to illustrate this. Imagine Lancaster Inc., again, a C corporation. They own a piece of manufacturing equipment. They originally purchased it for $100,000.
Okay.
Over the years, they've diligently taken $30,000 in depreciation deductions, which reduce their taxable income. This means the equipment's adjusted basis, its tax cost, is now $70,000.
Right. 100K minus 30K.
Correct. $70,000 basis.
Now, they decide to sell this equipment for $95,000.
Okay.
So the recognized gain here is $25,000. That's the $95,000 selling price minus the $70,000 adjusted basis.
$25,000 gain. Okay.
So for the Section 1245 recapture, we need to figure out how much of that $25,000 gain is ordinary income. You compare the recognized gain, $25,000, to the accumulated depreciation taken, $30,000.
Right. The lesser of those two. The lesser of these two amounts is $25,000. So in this scenario, the entire $25,000 gain is recaptured as ordinary income.
The whole gain.
Yeah, whole thing. There's no remaining gain to go to Section 1231, no capital gain treatment whatsoever for this asset sale. This example vividly highlights how a gain on personal property, especially if it's less than or equal to the total depreciation taken, can be entirely reclassified as ordinary income.
Yeah.
Meaning it's taxed at your highest marginal rates. That's a significant difference in tax liability that I think many business owners might overlook.
That's a crucial point.
Mm-hmm.
It means if you're selling business equipment, you need to be acutely aware that a significant chunk, possibly even all, of your gain might be taxed at your higher ordinary income rates, not the potentially lower capital gain rates you might have been hoping for.
Right.
This is absolutely critical for accurately forecasting your tax liability and managing your cash flow post-sale.
Definitely need to factor that in.
To really drive this home and show how these rules interact, let's look at a more comprehensive application with example 3, Roberts Printing Inc. This is a Schedule C sole proprietorship, so taxed to the individual, and they sold a few different assets in 1 year, giving us a great chance to see the full flow.
Okay, multiple assets. Good example.
Yeah, they sold a printing press, a photocopier, and a delivery van.
Okay, so let's break this down step by step, just as Roberts Printing Inc. would have to. First, step 1, calculate the gain or loss on each individual asset.
Right.
The printing press originally cost $6,800. They'd taken $3,200 in accumulated depreciation, leaving an adjusted basis of $3,600. They sold it for $4,000, resulting in a $400 gain.
Okay, $400 gain on the press.
Next, the photocopier. Cost $2,500, with $500 in accumulated depreciation, making its adjusted basis $2,000. Sold it for $2,600, gave them a $600 gain.
$600 gain on the copy.
Finally, the delivery van. This one cost $15,000, and they depreciated it by $13,000, bringing its adjusted basis way down to $2,000.
Lots of depreciation there.
Yeah. Unfortunately, they only sold it for $500, resulting in a $1,500 loss.
Ouch. Okay, $1,500 loss on the van.
Right. So 2 gains, 1 loss.
Okay, now step 2. This is where Section 1245 depreciation recapture kicks in, converting a portion of those gains into ordinary income. Both the printing press and the photocopier are Section 1245 personal property that were sold at a gain.
Right. Their equipment.
Exactly. So for the printing press, the gain was $400. The accumulated depreciation was $3,200. The lesser of these two is $400. So $400 of that gain is immediately reclassified as ordinary income.
Okay, the full $400 gain is ordinary.
Yep. Now for the photocopier, the gain was $600. The accumulated depreciation was $500. The lesser of these is $500. So $500, that $600 gain is ordinary income.
So $500 ordinary, leaving $100 of gain somewhere else.
Precisely. This means that from these two sales alone, a total of $900, $400 plus $500, is recognized as ordinary income due to depreciation recapture.
$900 ordinary income.
That's a substantial chunk of income that moves from potentially capital gain rates to higher ordinary rates, just based on those prior depreciation deductions.
Right. And then in step 3, we determine the character of any remaining gain or loss and send it to be netted under Section 1231.
Okay, the 1231 pool.
From the printing press, since the entire $400 gain was recaptured as ordinary income, there's nothing left to go to Section 1231. Zero.
Makes sense.
From the photocopier, like you said, after the $500 ordinary income recapture, there's a remaining $100 of gain. $600 total gain minus $500 ordinary. This $100 now flows into the Section 1231 pool.
Okay, 100 and 231 gain.
And the delivery van, remember, had that $1,500 loss. Losses on Section 1231 property always go directly into the 1231 netting pool.
Right, losses go straight to 1231.
So we net these Section 1231 amounts. We have a $100 gain from the photocopier and a $1,500 loss from the delivery van. The result is a net Section 1231 loss of $1,400.
Net loss for 1231.
And because it's a net 1231 loss for the year, it's treated as an ordinary loss.
Ah, the favorable outcome.
Exactly. This is fantastic news for Roberts Printing Inc. because they get to deduct that full $1,400 loss without limitation against their other ordinary business income.
That's a great result.
This full deduction is a truly significant tax benefit, showcasing the power of Section 1231 to provide immediate and favorable ordinary loss treatment, even after accounting for depreciation recapture on other assets. It's a complex dance, but knowing the steps can really save you money.
That example really ties it together nicely.
Okay.
Moving on to Section 1250. Now we're shifting gears to talk about depreciable real property used in a trade or business for more than 12 months.
Real property, so buildings, warehouses.
Exactly. Assets like a warehouse, an office building, or a manufacturing facility itself.
R-
But crucially, it does not include the land underneath.
Right, because land isn't depreciated.
Correct. Land is generally not a depreciable asset for tax purposes. Now, Section 1250 rules historically differed quite a bit from Section 1245. Its original intent was to recapture only the depreciation taken in excess of straight-line depreciation.
Excess depreciation, what's that?
Well, this distinction arose because, in the past, real property could sometimes use accelerated depreciation methods. That meant you could deduct more depreciation in earlier years than with the simple straight-line method.
Ah, faster write-offs early on.
Exactly. The government wanted to claw back that extra benefit if you then sold the property for a gain. However, it's really important to note a significant change. For most real property acquired after 1987, current law generally requires the use of straight-line depreciation.
Oh, so no more accelerated methods for most buildings now.
Generally, no, which means for most individual taxpayers selling property bought after 87, the excess depreciation rule for Section 1250 recapture doesn't typically apply in the same way it did for older assets, because there is no excess depreciation to recapture.
Okay, so 1250 is less of a big deal now.
Not quite. There are still special rules that apply, especially for C corporations, and for a concept known as unrecaptured Section 1250 gain for individual taxpayers. These are the nuances that can truly surprise you.
Ah, okay, so it's different but still important. Let's start with C corporations. You mentioned Section 291.
Right.
That's where Section 291 comes in specifically for C corporations.
Mm.
If you run a C corporation and you're selling depreciable real property, that is, a Section 1250 asset at a gain, Section 291 has its own specific recapture rule you absolutely need to be aware of.
You need to C Corp.
Yes. Here, 20% of the lesser of the recognized gain or the accumulated straight-line depreciation is treated as ordinary income. Think of it as a special corporate carve-out.
20% of lesser of gain or straight-line depreciation.
Okay. Any remaining gain after this 20% ordinary income recapture is then treated as a Section 1231 gain, which then goes into the overall 1231 netting process. It's a unique rule that applies only to C corporations, not to other business structures like sole proprietorships or partnerships. So it's critical to understand your entity type.
Let's use example 4 to see this Section 291 rule in action for a C corporation. Imagine Lancaster, Inc. Again, they own a building that originally cost $100,000. Over the years, they've taken $15,000 in straight-line accumulated depreciation on it.
Right.
This means the building's adjusted basis is now $85,000. Now, Lancaster, Inc. sells this building for $95,000. The recognized gain on the sale is $10,000, $95,000 selling price minus $85,000 adjusted basis.
$10,000 gain.
Now, for the Section 291 recapture calculation, we take 20% of the lesser of the recognized gain, $10,000, or the accumulated straight-line depreciation, $15,000.
Lesser is $10,000.
Right. The lesser of those two amounts is $10,000. So we calculate 20% of $10,000, which equals $2,000.
$2,000 ordinary income.
Exactly. This $2,000 is immediately treated as ordinary income for Lancaster, Inc. The remaining gain of $8,000, $10,000 total gain minus $2,000 ordinary income is then recognized as a Section 1231 gain.
And that $8,000 goes to the 1231 pool.
Correct. This $8,000 then proceeds to the Section 1231 netting process, potentially becoming a capital gain or being subject to the look-back rule. So if you run a C corporation and are considering selling real estate, definitely remember this 20% ordinary income rule. It's a distinct and important factor in your post-sale tax planning.
Right, directly impacts the taxable character of the gain. Okay, so that's C-Corp. Now let's talk about Section 1250 recapture specifically for individual taxpayers. You said this is where things get nuanced and maybe surprising.
Yes, this is where the rules get a little more nuanced and where many taxpayers experience that aha moment, often, unfortunately, after the fact.
Okay.
For individuals selling Section 1250 property at a gain again, think business real estate like a warehouse or office building bought after 1987. The gain is initially characterized as a Section 1231 gain.
So it starts as 1231.
It starts as 1241. It then gets thrown into the mix, netted with all your other Section 1231 gains and losses to determine if you have an overall net Section 1231 gain or loss for the year.
Okay, same netting process.
Same netting process. But here's the critical distinction for individuals. If you have an overall net Section 1231 gain for the year, before applying that 5-year look-back rule we discussed earlier.
Uh-huh.
A very specific portion of that gain is classified as unrecaptured Section 1250 gain.
Unrecaptured Section 1250 gain. Okay,
Yeah.
what's that?
This amount is calculated as the lesser of the recognized gain on the sale of that specific Section 1250 asset or the accumulated depreciation you took on that particular asset.
Lesser of the gain or the depreciation on the building itself.
Exactly. And here's the kicker. This unrecaptured Section 1250 gain is then taxed at a maximum 25% capital gain rate.
25%, not 0, 15, or 20.
Correct. Why is this critical? Because this is a special rate that sits higher than the typical 0%, 15%, or 20% long-term capital gain rates that apply to other regular net Section 1231 gains or other capital assets like stocks.
Wow. Okay, so it's still capital gain, but potentially a higher rate.
Exactly. And furthermore, when that 5-year look-back rule comes into play, remember, the rule that turns net 1231 gains into ordinary income to pay back prior ordinary losses.
Right, the payback rule.
It applies first to this unrecaptured Section 1250 gain component.
It hits the 25% gain first.
Yes. Only after that 25% potential gain component is fully used up to recapture prior losses does the look-back rule then apply to any other regular net Section 1231 gains, the ones potentially taxed at 0.152%.
Okay, the order matters significantly.
The order matters a lot. It can significantly impact how much of your gain ends up being ordinary income versus taxed at the 25% rate versus the more preferential 0.152% rates. It's a true tax puzzle where the order of operations really, really matters.
Okay, let's illustrate this with example 5. We have Lancaster Company, but this time structured as a sole proprietorship, meaning it's taxed directly to the individual owner.
Okay, individual taxpayer now.
If Lancaster Company sells a building that originally cost $100,000 and on which they've taken $15,000 in straight-line accumulated depreciation for a sale price of $95,000, the recognized gain is still $10,000. $95K sale price minus $85K adjusted basis.
Same $10,000 gain.
Right. For simplicity, let's assume there were no other 1,231 sales or prior Section 1231 losses in the current or previous 5 years. No look-back needed here.
Okay, clean slate.
This entire $10,000 gain is initially a Section 1231 gain. Now, because it's a Section 1250 asset sold by an individual taxpayer, the entire $10,000 is classified as unrecaptured Section 1250 gain. Why?
Because it's the lesser of the gain or the depreciation.
Exactly. It's the lesser of the $10,000 recognized gain or the $15,000 accumulated depreciation. So the entire $10,000 gain is taxed at that special 25% Section 1250 capital gain rate.
The whole gain at 25%.
The whole gain. None of it qualifies for the more favorable 0%, 15%, or 20% long-term capital gain rates you might expect from a typical capital asset sale. This is often where those big aha moments happen for taxpayers.
Yeah, I can see that.
They might expect a lower capital gain rate, but these specific depreciation recapture rules create this distinct 25% layer that catches many by surprise. It truly emphasizes the importance of knowing these nuances.
Absolutely. Let's delve into an even more complex application where these rules start to really interweave. Example 6 involves Chandra Co. This is another Schedule C sole proprietorship individual taxpayer.
Okay.
And they had a busy year, selling both a warehouse and land during the same tax period.
Warehouse and land.
The warehouse generated a $35,000 gain, and they had taken $20,000 of accumulated depreciation on it. The land generated a straight $10,000 gain, no depreciation on land.
So $35K plus $10K, $45K total gain initially.
Correct. This gives us a total initial net Section 1231 gain of $45,000. Now, crucially, Chandra Co. also had a Section 1231 loss in a previous year, specifically $15,000, which was deducted as an ordinary loss at that time.
Ah, the look-back rule is coming.
Exactly. This is exactly the kind of prior benefit in the 5-year look-back rule targets. So here's how we navigate this complex situation.
Okay, break it down for us.
First, we confirm the total net Section 1231 gain for the current year is $45,000.
Got it. $45K.
Next, we identify the unrecaptured Section 1250 gain component from the warehouse sale. For the warehouse, the Section 1250 gain is the lesser of the $35,000 recognized gain or the $20,000 accumulated depreciation.
Lesser is $20,000.
Right. So $20,000 of that total $45K gain is specifically classified as unrecaptured Section 1250 gain.
Okay, $20K at the potential 25% rate.
Potentially. This leaves $25,000, $45,000 total net 1231 gain minus $20,000 Section 1230 gain as a regular net Section 1231 gain. This is the part potentially taxed at 0.1521%.
25K regular 1231 gain.
Okay, now we apply the 5-year look-back rule to that $15,000 prior Section 1231 ordinary loss. Remember, the look-back applies first to the unrecaptured Section 1250 gain component.
Hits the 20K portion first.
Yes. So we'll take $15,000 of that $20,000 Section 1250 gain and convert it to ordinary income to recapture that prior loss. This is like paying back that previous tax benefit.
So $15 of the gain becomes ordinary income.
Correct. After that conversion, we are left with $5,000 of the Section 1250 gain. $20,000 initially identified minus the $15,000 converted to ordinary. This remaining $5,000 is taxed at the 25% Section 1250 capital gain rate.
Okay, 5K to 25%.
Then, the remaining $25,000, which was categorized as the regular net Section 1231 gain, wasn't touched by the look-back rule because the prior loss was fully recaptured from the 1250 portion. So this $25,000 is taxed at the more favorable 0%, 15%, or 20% long-term capital gain rates.
Wow. Okay, that's a lot of moving parts. So if I'm tracking this correctly, out of the total $45,000 recognized gain for Chandra Co., the outcome is quite diversified. $15,000 is taxed at ordinary rates due to the look-back rule. $5,000 is taxed at that specific 25% Section 1250 capital gain rate.
Right.
And then the remaining $25,000 gets those typical, more preferential long-term capital gain rate.
You nailed it. That's the breakdown.
This example powerfully demonstrates that if you own a business with real estate, understanding this unrecaptured Section 1250 gain and its intricate interaction with the 5-year look-back rule is absolutely critical.
It really is.
It means that even if you have a substantial net Section 1231 gain, a significant portion of it could be subject to a higher 25% capital gain rate, or even converted entirely to ordinary income, rather than benefiting from your typical long-term capital gain rates.
Exactly.
This is often where big aha moments happen for taxpayers, directly impacting their tax strategy and the actual after-tax proceeds they walk away with from a sale. It highlights why proactive planning and knowing your past tax history are so vital.
Couldn't agree more.
Wow, that truly was a journey through some dense tax code. But now that we've unpacked the individual pieces, let's try to bring it all together and summarize the entire flow of a gain or loss, maybe starting with individual taxpayer.
Good idea. A recap helps solidify it.
Just to recap for my own understanding and for our listener, because that was a dense but incredibly important breakdown, what's the core takeaway here about how these pieces fit together for an individual taxpayer?
Okay. Well, what stands out here is the layered complexity, yes, but also the sort of deliberate design of the tax code. It seems to encourage business activity through favorable loss treatment, while also ensuring that depreciation benefits are somehow paid back on gains.
Right, that balancing act again.
Exactly. So here's how it generally flows for individuals, almost like a decision tree.
Okay.
1. Calculate gain-loss on each asset. You start by calculating the gain or loss on a sale of each long-term trade or business use asset. Simple enough. 2. Initial classification. Now, how it's initially treated depends. If it's a loss, easy peasy. It immediately goes into the Section 1231 pool. If it's a gain, the tax treatment depends on the specific type of asset, land. Gain on land just goes directly to the Section 1231 pool. No depreciation, no recapture. Personal property, Section 1245. Here, Section 1245 depreciation recapture kicks in first. Remember, the lesser of your gain or your accumulated depreciation is treated as ordinary income. Any remaining gain after that recapture then joins the Section 1231 pool. Real property, Section 1250. Any gain on real property also directly joins the Section 1231 pool. For individuals, remember, we don't usually worry about excess depreciation recapture for newer properties, but the total depreciation matters for the next steps.
Okay, so losses and land gains go straight to 1231. Personal property gains get recapture first, then maybe 1231. Real property gains go to 1231. So once all those individual gains and losses have found their way into the Section 1231 pool, what's the next step in this intricate process?
The next crucial step is to combine all 1231 gains and losses. You net everything in that pool together. This netting determines the overall character for the year.
Okay.
That's Section 1231 loss. If the result of this netting is a net loss, then it's fantastic news. That entire amount is treated as an ordinary loss. This is a massive win, fully deductible against your other ordinary income, no $3K limit.
The best outcome for a loss.
Definitely.
Yeah.
Net Section 1231 gain. If, however, the netting results in a net gain, this is where the special distinctions for individuals kick in. That net gain effectively splits into two crucial components before we even think about the 5-year look back. Unrecaptured Section 1250 gain. This is the portion of the net 1231 gain linked to the sale of depreciable real property. Specifically, it's the lesser of the gain recognized for each building or the accumulated depreciation on that specific building, summed up if you sold multiple. Regular net Section 1231 gain. This is basically everything else. It's the remainder of your net 1231 gain after you've carved out the unrecaptured Section 1250 gain.
Okay, so the net gain splits into those two buckets first. And then the final crucial puzzle piece, the infamous 5-year look-back rule. How does that apply to these two components?
Exactly. The look-back rule then comes into play, and its application order is paramount. Your overall net Section 1231 gain becomes ordinary income to the extent of any unrecaptured ordinary 1231 losses you had in the previous 5 years. The order matters.
Right, order is key.
It applies first to the unrecaptured Section 1250 gain component. So if you have prior ordinary 1231 losses to recapture, they first eat into that 25% potential gain and convert that portion to ordinary income.
Pays back using the 1250 gain first.
Then, if there's still any unrecaptured prior losses left over after exhausting the 1250 gain, they apply to the regular net Section 1231 gain component, converting that part to ordinary income.
Okay, and what's left after all that?
What's left after the look-back rule determines your final tax rates. Any remaining unrecaptured Section 1250 gain after the look-back is taxed at that special maximum 25% capital gain rate. And finally, any remaining regular net Section 1231 gain after the look-back is taxed at those more preferential 0%, 15%, or 20% long-term capital gain rates. This part then gets netted with any other long-term capital gains or losses you might have from, say, stock sales.
That's a truly detailed and comprehensive flow for individuals. It's complex, for sure, but understanding each step is vital for predicting your tax outcome and for smart financial planning. It's really a journey, not just a single destination when it comes to these asset sales.
Well said. And the flow for C Corporation taxpayers shares many similarities, but it also has very key differences, especially in the depreciation recapture for real property.
Right, the Section 291 thing.
Exactly. If we connect this to the bigger picture, it really highlights that the type of entity you operate under, whether you're an individual filing a Schedule C, an S-corp owner, a partner, or a C corporation, profoundly impacts how gains on business property are taxed. Your overall tax planning strategy absolutely must account for this.
So how does it look for C Corp?
For C corporations, you begin in much the same way. Calculate the gain or loss on each long-term trade or business use asset. Losses still go directly to the Section 1231 pool.
Okay.
For gains, land still goes to the Section 1231 pool, just like for individuals. Personal property sold at a gain also has Section 1245 depreciation recapture. 100% of the lesser of the gain or accumulated depreciation is treated as ordinary income, and any remaining gain goes to the Section 1231 pool. That part's consistent.
Okay, so the big divergence then comes with real property for C corporations. That's Section 291.
Precisely. Here's where the C corporation path diverges for real property. When a C corp sells real property, Section 1250 asset at a gain, Section 291 depreciation recapture applies. This is that specific corporate rule.
The 20% rule.
Right. It means that 20% of the lesser of the recognized gain or the accumulated straight-line depreciation is treated as ordinary income. This is a mandatory ordinary income conversion just for C Corp. The remaining gain, if any, then joins the Section 1231 pool.
So they don't have the 25% rate, but they have this 20% ordinary hit.
Exactly. It's a distinct rule from how individuals treat Section 1250 property with the unrecaptured Section 1250 gain and the 25% rate. So while corporations don't have that specific 25% rate layer, they do have this mandatory 20% Section 291 ordinary income recapture on real estate depreciation.
Okay. And then the final netting for C Corp.
Finally, for C corporations, all gains and losses in the Section 1231 pool are combined. If it's a net Section 1231 loss, it's an ordinary loss. Same as for individuals, great tax benefit, fully deductible.
Good.
But if it's a net Section 1231 gain, the 5-year look-back rule still applies, exactly as it does for individuals, turning that gain into ordinary income to the extent of any unrecaptured 1231 ordinary losses from the previous 5 years.
Same look back.
Same look-back. Any gain remaining after that look-back is treated as a capital gain. But for C corporations, capital gains are simply taxed at their regular corporate tax rate, which is currently a flat 21%.
Ah, no preferential rates for C Corp capital gains.
Correct. No 0.1520%. So while C corporations don't have the complex layers of the 25% unrecaptured Section 1250 gain rate, they do have the mandatory 20% Section 291 ordinary income recapture, and their final capital gain is taxed at the standard corporate rate. It's a different beast, but equally important to understand for planning.
This has been a true deep dive, and wow, we've covered a lot of ground, from initial asset classification all the way to the nuances of depreciation recapture and those powerful, sometimes tricky 1231 rules. So let's wrap this up with your key takeaways. What's the essential passkey for our listeners to understanding and optimizing their tax position when selling business assets? What should they really commit to memory?
Okay, the condensed version, the actionable insights for strategic tax planning. Here's your key takeaway from this deep dive.
Let's hear it.
Firstly, and this is a significant advantage for any business owner, remember this, a net loss on the sale of trade or business use property held long-term is always an ordinary loss.
Always ordinary loss. Big benefit.
Always. This is crucial for tax planning because it means the full amount of that loss is generally deductible against your other ordinary income without the limitations that often apply to capital losses. It's a powerful tax benefit, don't forget it.
Okay, what's next?
Secondly, it's vital to understand that whether a gain is ordinary or capital depends heavily on two things. The specific type of property you're selling. Is it personal property like equipment or real property like a building? And the type of taxpayer you are. Are you an individual, maybe filing Schedule C, or are you a C corporation?
Property type and taxpayer type.
Exactly. There's no one-size-fits-all answer, which is precisely why this detailed understanding is so important for making informed decisions and avoiding costly surprises.
Got it. And the triggers for ordinary income.
Thirdly, be acutely aware that there are specific triggers that will convert part or even all of your gain into ordinary income, which generally means a higher tax rate. These include Section 1245 depreciation recapture. This converts 100% of the lesser of your gain or your accumulated depreciation on personal property into ordinary income. It's the IRS taking back those prior deductions. Section 291 depreciation recapture. This applies specifically to C corporations selling real property, converting 20% of the lesser of the gain or accumulated depreciation into ordinary income. The 5-year look-back rule. Any net Section 1231 gain can turn ordinary due to this rule, recapturing prior ordinary 1231 losses. And remember, for individuals, this hits the unrecaptured Section 1250 gain first. Knowing these triggers helps you anticipate your tax liability much more accurately.
Okay, know the ordinary income triggers. And finally, despite all these complexities and potential ordinary income hits, there are still significant capital gain opportunities, right?
Absolutely, you should leverage those. This includes any remaining net Section 1231 gain after the 5-year look-back rule has been applied.
How does that break down again?
For individual taxpayers, this means potentially two distinct layers of capital gain. You have the unrecaptured Section 1250 gain, which is taxed at that special maximum 25% capital gain rate. And then you have the regular net Section 1231 gain, which enjoys those very favorable 0%, 15%, or 20% long-term capital gain rates. For corporate taxpayers, any remaining capital gain after look-back is taxed at their regular corporate rate, currently 21%.
So different flavors of capital gain depending on who you are and what you sold.
Precisely. Understanding these distinctions allows you to proactively manage your tax burden and truly optimize your after-tax proceeds when you sell a significant business asset. It really is about knowing the rules of the game to play it best.
That's a great summary.
You know, navigating the disposition of business property isn't just about crunching numbers in the end. It's really about understanding the narrative, the story of your asset's life. From its initial acquisition through all the depreciation deductions you took that hopefully reduced your taxes year after year, and finally to its sale. Each stage impacts its ultimate tax character. Knowing these nuances means you're not just reacting to tax bills after the fact, but you're proactively shaping your financial future. So maybe the next time you consider selling a major business asset, ask yourself, have you truly accounted for every potential reclassification of that gain or loss and its precise impact on your tax strategy?
That's a powerful final thought. This deep dive really reveals that what might seem like a straightforward business sale can have incredibly intricate tax consequences. It offers both challenges, certainly, but also substantial opportunities for significant tax savings if you plan correctly. The more you understand these rules, the better equipped you are to make informed decisions that directly impact your wealth, your bottom line, and ultimately, your financial freedom. So keep digging, keep learning, and keep asking those important why questions about your tax situation. Your wallet will definitely thank you.